Michael Arone is chief investment strategist at State Street Global with over $3 trillion in assets under management. Michael, this is really the crux of things, because those who think earnings are looking good for next year can kind of shrug off everything else happening and say it's time to embrace it, and then others aren't so sure. So you have some confidence here or no?
Well, Kelly, I think it's interesting. As you said, earlier this year, it was all about beating very low expectations when it came to earnings. So we had this earnings recession, yet markets rallied anyway because results were much better than anticipated. So my concern is the setup for 2024 is that now we're expecting earnings growth for S&P 500 companies of more than 11%. So I do think that the risk of disappointment has grown. Even though earnings are likely to be pretty good, I'm not sure they're going to live up to those higher expectations. And how the market reacts to that does concern me.
Michael, is 24 finally going to be the year for bonds?
I'm not so sure. I do think that bonds are more attractive, John. So when we look at kind of the yield that you're receiving for the interest rate risk that you're taking, that duration that you're taking, it's more in balance than it has been since 2009. So it is a much more attractive picture for bonds. But we still see most investors barbell. So very conservative on the short end of the curve with treasury bills and short maturities, while balancing that a little bit with things like investment grade corporate bonds, for example, where I'm taking on a little bit more credit risk, a little bit more interest rate risk, but I'm not taking on too much. And yet those yields are commensurate or similar to what's on the short side of the fixed income portfolio. So that seems to be the right kind of balance, if you will, for fixed income allocations as we head to 2024.
How much danger is there, though, for the retail investor in watching the price of bonds themselves too closely and not thinking long-term about the yields? Because so many retail investors have tilted much more toward stocks, toward equities over the past couple of decades and are way out of that traditional balance.
It's true, but they've been rewarded, at least over the long term, for taking on that additional equity risk. And I do think that the setup is for that to continue over the longer term. But John, you're right. In terms of the opportunity for bonds, it's certainly more compelling now than it was over the last decade or so in terms of income and total return. So we are seeing fixed income allocations creep up. I think one of the more interesting things is that when income was scarce, it forced investors to take a lot of risk in fixed income that they may or may not have been comfortable with. Now, with income more plentiful, the allocations to fixed income continue to remain challenging. Most folks have gotten that interest rate call wrong this year as rates continue to back up. That's why we think stable income is kind of the way to go, in that balance, that barbell between kind of conservative fixed income on the short end and, to your point, adding some maturities, adding some fixed income in terms of the intermediate part of the curve, we think makes some sense.
Still amazing to look at 411 there on the 10-year and how far it's fallen in such a very quick period of time. So you're interested in hedging against a lot of these risks with gold. So the outperformance of gold lately, is that partly what's driving your interest, or does that kind of make logical sense to you and you think it keeps going?
I think what's been fascinating about gold this year, Kelly, is that interest rates have climbed. Certainly they're off of their highs since the end of October, but interest rates are up kind of this year. The dollar has strengthened somewhat unexpectedly this year, up until recently. These are two traditional headwinds for gold, yet the spot price of gold is up in the teens. So it's overcome those headwinds. And now all of a sudden, yields are falling, as you point out, on 10-year Treasury yields. The dollar is likely to weaken, particularly as the Fed ends its tightening cycle. That's starting to happen. And now you all of a sudden have a much more attractive backdrop for gold at a time when the outcomes across a wide range of things are wider than normal. Geopolitical risks, the economy, the Fed, inflation, earnings like we talked about up front. So we think hedging a lot of these risks with a small gold allocation makes sense. In 2022, spot price of gold was flat while stocks and bonds were down. This year, gold's remained competitive with stocks, even though they're up considerably. We think the backdrop remains attractive in 2024.
All right.